Hello, I'm Lindsay Hall, Chief Market Strategist for the RMB Group. Welcome to our video series, A Short Course in Futures and Options. In this lesson, we will help you understand some of the advantages to using futures and futures options in certain time periods. There are tax advantages to using futures and futures options in certain time periods. As we mentioned earlier, futures and futures options are regulated by the Commodity Futures Trading Commission, or the CFTC. Securities products like stocks, mutual funds, and ETFs are regulated by the Securities Exchange Commission, or the SEC. Since they are regulated by a separate entity, futures and futures options have a different tax treatment than stocks, stock options, and ETFs. At the time of this report, traditional investments like stocks have a two-tiered tax structure. Long-term capital gains for investments held more than 1 year are capped at 15%, while short-term capital gains, those held less than a year, are taxed at the investor's personal income tax rate. Futures and futures options, on the other hand, have a single-tiered tax structure. 60% of all gains are taxed at the long-term rate and 40% at the short-term rate, no matter what the holding period. It could be 1 hour or 1 year. The tax treatment is the same. If you buy a crude oil call option for $2,000 today and sell it for $3,000 tomorrow, $600 of your $1,000 profit will be taxed at the 15% long-term rate. The other $400 will be taxed at the short-term rate. Compare this to energy stocks, ETFs, or options on either. If held for less than 1 year, your entire profit would be taxed at short-term capital gains rate. In this case, you'd be better off using CFTC-regulated products like futures and futures options from a tax perspective, all else being equal. Futures and futures options are also marked to the market for tax purposes at the end of each calendar year. Let's say you began the year with $30,000 in your account, didn't add any new money, and at the end of the year, your account was worth $40,000. $6,000 of your $10,000 gain would be taxed at the 15% long-term rate. $4,000 would be taxed at the short-term rate, whether or not you still own the positions. $40,000 would then become your new tax basis for the following year. Losses would be treated the same way. 60% would be long-term, 40% would be short-term. Your broker will send you one form at the end of the year showing your gains and losses. Some of these forms will even tell you where to enter them on the IRS forms. Please be aware that the information in this section is subject to changing tax laws. Be sure to check with your accountant for the latest. You have now finished our 10th video in this series, and there's only one more left. Our final video, putting it all together and getting started, will help you sum it up and begin your new journey in the world of futures and futures options.